I'm going to cover very briefly the EIS qualification rules. I think most of you are probably familiar with that, but focus a little bit more at the end on the changes in the budget, and also some of the longer term plans for EIS that we've seen from the patient capital review. So first of all, as you know, EIS is focused on early stage unquoted trading companies. There's a list of non-qualifying activities, and provided the company is not on that list, that's a good starting point if the trade's not on the list. Since November 2015, EU state aid rules put certain limits on EIS investment, and one of those was a 7-year rule. So unless the company had raised other state aid in the first 7 years, any company older than 7 years couldn't raise EIS money, and that was extended to 10 years for knowledge-intensive companies. There was an employee limit, 250 employees at the time of the fundraising for EIS, 500 for knowledge-intensive companies, and there's a gross asset test of 15 million, so the company mustn't, or the group, mustn't have more than 15 million gross assets immediately before the fundraising, 16 million after. And another rule that came in more recently was that the company can only raise in any 12-month rolling period 5 million from EIS and other state aid. And an interesting point in the budget was that's now been increased to 10 million for knowledge-intensive companies. But there's still a 12 million lifetime limit for ordinary EIS companies, if you like, and 20 million for knowledge-intensive companies. So although a knowledge-intensive company could raise 10 million in a 12-month period, it's still capped at the 20 million lifetime limit, so 2 funding rounds if it did the maximum, 10 million each. The relief, as far as individuals are concerned, is 1 million in a tax year. It's also possible to carry back a tax year. But again, in the budget there was a change, so it can go up to 2 million, provided 1 million of it is in knowledge-intensive companies. So you can have 1 million of ordinary EIS, if you like, and then another 1 million of knowledge-intensive companies on top to bring it up to 2 million. The income tax relief is 30% on investment. There's also deferral relief available, and there's the capital gains tax exemption after holding the shares for 3 years. Because they're unquoted trading companies, then inheritance tax business property relief applies, so exempt from inheritance tax after 2 years. And there's also a loss relief on, hopefully you won't make any losses, but on losses you can set those against income as well as against capital gains, which is very useful. Just to compare with venture capital trusts, they're a bit more of a retail investment. So there you're investing in a PLC, which then invests in underlying companies. The income tax relief is still 30%, but the CGT exemption is only after 5 years of ownership. And it also has tax-free dividends, but doesn't have a deferral relief. So although they invest in the same kind of investee companies, slightly different rules as far as investors are concerned. And also because you're investing in a listed company, it's not qualifying for the inheritance tax relief either. So what's been changing? Well, there was a patient capital review about a year ago. It started with questions going out, some comments from individuals in the industry. And it was quite encouraging actually, the response that came back in some ways, that they did see EIS as actually being successful. The initial stage fundraising using tax benefits was actually raising quite a lot of money, and compared to other countries was doing very well. So it's been extremely successful at the CDIS, EIS and VCT stage. But they did find that in the next stage of funding there was a bit of a struggle. Once the limits have been met and the tax reliefs are no longer available, the return for people investing in venture capital wasn't quite high enough if you don't have any tax reliefs to go along with it. And so they've come up with a few solutions. One is a patient capital investment vehicle to invest in these type of companies on scale-up path. The second is a patient capital investment company program, which seems to be trying to mirror something in the US, where there's debenture funding, which really gears up the equity element so that the equity holders get a bigger return, obviously, once the debt's paid off, so a bit like the private equity model. And the US government say it's a nil cost to them overall, the way it works financially. And the idea of that is to try and increase the returns for venture capital investors, those that don't have the tax relief, that is. And as far as the EIS and VCT schemes, there were lots of rumours prior to the budget, and I was at one of the meetings with Treasury where they said, we just don't think we're getting value for money from EIS investments, which rang alarm bells with everyone. We thought they might be looking to scrap the relief. But really what they were concerned about was some of the low-risk protected capital funds that were out there rather than the real venture funds. And so there's been a change in the emphasis. And in fact, there's been, as we just heard, an improvement to the rules for knowledge-intensive companies. So they're actually trying to focus the relief in the right area. Building on knowledge-intensive companies was one of the outcomes that came out of the patient capital review. They were also talking about this bullet here about follow-on funding to scale up businesses by possibly having a growth EIS or VCT with a reduced level of tax relief. So in other words, once the current limits for EIS are exceeded, rather than having zero tax relief, to have a lower tax relief. So again, we may well actually see some improvements to EIS, so we keep what we've got, but also have some further relief further down the line as well. They've also talked about removing the connected party 30% test, which does help in certain circumstances as well. So on the whole, I think the outcome of the patient capital review, we thought EIS might be scrapped, but actually they seem to be really encouraged to get behind it, but just tighten up the rules. So let's look at what the actual changes were that came out in the budget, which came out at the same time as a patient capital review outcome. The first one is the improvement for knowledge-intensive companies. So as we said, for individuals, it's possible now to get 2 million in a tax year relief. The company raising money, if it's knowledge-intensive company, can raise 10 million in a 12-month period rather than 5. And the third one's an interesting one, the 10-year rule. So for a knowledge-intensive company, it was measured the 10 years from its first commercial sale. And it was quite difficult to establish when the first commercial sale was. Now the rule is going to be once the annual turnover has reached 200,000. So that will actually mean the 10 years is actually longer, because rather than from the very first sale, if it takes 3 years to get the turnover up to 200,000, then it could well be a 13-year period. But the big tightening up is on this risk to capital condition. So they want to make it principles-based, taking a reasonable view, which is all very encouraging, provided the HMRC inspectors in a year or two don't start treating their interpretation of it slightly differently. But the way it's drafted at the moment looks fine as far as real venture investments are concerned. So the first broad theme is that the company must have its objectives to grow and develop over the longer term. So often you see companies out there raising money that will just say, we'll raise money and in 3 years' time we'll liquidate or we'll sell, and it's just a fixed period project finance really. So that kind of thing they want to stop. They want it to be over a longer period. And the second one is that, and in the guidance, the way it's drafted doesn't actually make sense, but what it's broadly saying is the investors got to have at risk more than they potentially stand to gain, or including any tax relief. And I think the wording needs to be tweaked there. I can understand what they're trying to get at, that if you've only got 100,000 at risk, then why should you get relief on £1 million, for instance? So I think they'll need to tweak the wording, but you can see the gist of where it's going. And then they list 7 factors. So these are not exhaustive. It does say they're non-exhaustive factors, but these are the kind of things they're looking at. It's a bit small to see, but the first one is that the company's objective is to increase the number of employees and the turnover. And it says over a longer period than just the 3-year period. So again, it's looking at, is this just project finance? Is this just in 3 years later on the dot, money comes back out again? If so, then that won't qualify, or the likelihood is it won't qualify. The second one is the nature of the income, whether that's risk-free income. So you see a lot investing in things like film and television programs where a lot of it is pre-sold already, so you know the income's guaranteed, or there may be something akin to a leasing type arrangement where the income's fairly guaranteed. Those kind of things. It doesn't mean it definitely won't qualify, but they're the kind of things that they're looking at. The third one, the extent to which the company's likely to have assets that could become party to arrangements and basically give security. So if you're a retailer and you've got a property in a business and that's used in the trade, that would be fine. I suspect that's aimed at things like some of the shipping EISs, for example, that kind of thing where you say you invest EIS money, we buy a ship for £2 million, and then after 3 years we know the ship's still worth £1.8 million. Now, life's never that easy, is it? Whether the ship really will be still worth 1.8 million in 3 years' time, who knows? But because these are sold as asset-backed type investments, that's really what the Treasury don't want to see. So that's another indicator. There's one about subcontracting the activities to persons not connected. So you see a lot of infrastructure type arrangements where the assets are in the EIS company and all the people are elsewhere. So that's one of the things they're looking to stop. Number 5 is looking at the ownership and management structure. So if you've got an EIS fund that sets up its own companies and then people invest and there's no real entrepreneur involved, then those kind of things, those self-created companies will be at risk. How are the investments marketed? So a lot of them are actually sold as asset protection, guaranteed income, all kinds of terminology in the IMs which are really not helpful. And whether they're true or not is a different matter as well, but certainly if that's the way you're marketing, then that's unlikely to qualify. And then finally, some of the arrangements for marketing and using special purpose vehicles. So some, particularly going back to film and TV again, people would set up, or even the infrastructure projects, you set up an SPV company, it trades for 3 years and then is sold. And often with film, you'll have company number 1 making one television programme or film, company number 2's formed to make a next one, company number 3. And what they've said is, if you want a special purpose vehicle for each film or each activity, that's fine, but it has to be under a holding company, because by doing them separately, you're getting the EIS limits for each different company and you're getting multiple limits. So we can see where HMRC are going with this. They're trying to cut back on the protected, lower risk type investments and really focus it on true venture capital where there's an entrepreneur or a management team behind something and then investors come in. So I think actually it will level the playing field to some extent, because a lot of the money, if there's a choice between something that seems guaranteed and something that seems riskier, then naturally more money goes towards the so-called low risk. VCT changes. Yeah, there were a few changes for VCTs as well, and again, this is really to tighten things up. So from 6th of April 18, they'll have to invest 30% of the funds within the first 12 months rather than 70 over 3 years. So just speeding up the investment process of VCTs. There'll be a prevention on loans being used to protect capital for investors. And 2 changes from April 19 is to the qualifying holding is going to increase from 70% of the total funds to 80%. Now the difficulty with that is if a VCT sells an investment and gets some cash in, it might not reach the 80% because it only currently has 6 months to reinvest. So as a quid pro quo to the increase to 80%, they're going to allow 12 months to resubscribe. So again, VCTs will be under a tightened system as well as having a tightened investee company base as well.